Today, we are going to study market multiples, comparable companies, and valuation judgment. This is one of the most practical topics in valuation. In real finance conversations, people often ask, what is this business worth compared with similar businesses? That is the heart of relative valuation. Intrinsic valuation looks inside the company. It focuses on expected cash flows, growth, reinvestment, and risk. Relative valuation looks outward. It asks how the market is already pricing other companies with similar economics. A market multiple is a compact market signal. It summarizes how investors are pricing a company relative to sales, earnings, book value, or cash flow. But here's the key idea. Multiples do not remove judgment. They require judgment. The real question is not simply, what multiple do the peers trade at? The stronger question is, what multiple is justified for this company, given its growth, profitability, reinvestment needs, risk, and competitive position? Let's start with the basic idea behind valuation multiples. A valuation multiple links a measure of value to a financial metric. The goal is to make companies easier to compare. Instead of discussing the full value of a business in isolation, we compare that value with something the business produces or owns. But the value measure and the financial metric must match economically. If we are valuing the operating business, we use operating metrics. If we are valuing the common shareholder's claim, we use metrics available to common shareholders. A disciplined multiples analysis usually follows a clean path. We begin by selecting a peer group with similar business economics. Then we calculate relevant multiples for those peers. After that, we choose a reasonable multiple or valuation range for the target company. Finally, we apply the selected multiple to a normalized financial metric for the target. The formulas can appear simple on the screen, but the thinking behind them is not mechanical. When we move from enterprise value to equity value, we must consider debt-like claims, cash-like assets, preferred stock, non-controlling interests, and other adjustments. The goal is not just to calculate. The goal is to compare correctly. Now let's make a crucial distinction. Enterprise value multiples versus equity value multiples. Enterprise value represents the value of the operating business available to all capital providers. That includes both debt investors and equity investors. Equity value represents the residual value belonging to common shareholders. This difference matters because valuation multiples must be internally consistent. Enterprise value multiples should be paired with operating metrics before financing effects. These metrics belong to the whole business before the company decides how to finance itself. Equity value multiples should be paired with metrics after financing effects. These metrics belong to common shareholders after interest expense, taxes, and other claims have been considered. A common mistake is mixing the two worlds. Enterprise value should not be matched with net income, because net income is after interest expense and belongs to equity holders. Equity value should not be matched with EBITDA, because EBITDA is before payments to debt holders and belongs to all capital providers. This consistency rule protects us from misleading conclusions. When leverage differs across firms, enterprise value multiples often provide cleaner comparisons. Equity multiples are still useful, but they can be distorted by capital structure, tax differences, and accounting choices. So remember, match the value claim with the metric claim. Now, let's discuss common valuation multiples. Different multiples highlight different parts of a business. None of them is perfect. Each one is useful in some settings and limited in others. EV to sales can be useful when earnings are temporarily low, negative, or distorted. It is often used for early stage or high growth businesses, but it ignores profitability. A company can produce revenue and still fail to create value if margins and returns are weak. EV to EBITDA is widely used in acquisitions and leveraged finance. It reduces the effect of capital structure and some non-cash accounting charges, but it can ignore capital expenditures, working capital needs, taxes, and differences in depreciation intensity. EV to EBIT moves closer to operating profit after depreciation and amortization. This makes it more sensitive to capital intensity, but it can still be affected by accounting estimates and temporary weakness in operating income. PE is familiar and easy to communicate. It connects market price to earnings available to common shareholders, but it can be affected by leverage, taxes, accounting policy, non-recurring items, and share repurchases. PB is often useful for financial institutions and asset-heavy companies, but it is less useful when value comes mainly from intangibles, growth options, or internally developed capabilities. So the question is never, which multiple is best? The question is, which multiple best captures this business? Comparable company analysis estimates value by examining how the market prices similar publicly traded companies. You may hear this method called trading comparables, public company comparables, or simply comps. The attraction is clear. The method uses observable market prices. We are not relying only on our own forecast. We are looking at how investors are currently pricing businesses that resemble the target. But the limitation is just as important. No company is a perfect twin. A peer group provides evidence. It does not provide a mechanical answer. The quality of the valuation depends heavily on the quality of the peer group. A company is comparable when its economics resemble the target's economics, not merely because it sits in the same broad industry. Important comparability criteria include business model, growth prospects, profitability, capital intensity, risk, scale, and accounting quality. Industry classification is only a starting point. A software platform, a consulting firm, and a hardware manufacturer might all be called technology companies, but their revenue quality, margins, reinvestment needs, and risk profiles may be very different. A good peer group should be narrow enough to be meaningful and broad enough to provide useful market evidence. Too broad, and the comparison becomes weak. Too narrow, and the analysis may depend too much on unusual firms or unusual trading conditions. Now let's talk about normalization. A valuation multiple is only as useful as the metric to which it is applied. Reported accounting numbers often include temporary, non-recurring, or non-operating items. Before applying a multiple, the analyst must ask whether the metric reflects sustainable performance. Common normalization adjustments include removing gains or losses from asset sales, adjusting for restructuring charges, litigation settlements, unusual impairments, acquisition costs, integration expenses, unusual tax effects, discontinued operations, unusual working capital movements, and temporary margin effects. For equity valuation, diluted shares should also be considered carefully. Normalization does not mean making the company look better. That is very important. Normalization means making the financial metric economically comparable across firms and representative of the cash flow capacity being valued. The adjustments should be transparent, defensible, and applied consistently. Analysts often consider both historical and forward-looking metrics. Recent historical performance is useful because it is based on actual results. Forward-looking metrics may be more relevant when the business is changing quickly, when margins are shifting, or when growth is expected to be very different from the past. Historical multiples may be more reliable when forecasts are uncertain or when the company is stable. So normalization is not a technical detail. It is central to valuation judgment. How do we choose the right multiple? The right multiple is the one that best captures the economics of the business and the claim being valued. For a mature operating company with meaningful operating earnings, EV to EBITDA or EV to EBIT may be useful because operating performance can be compared before financing differences. For a capital-intensive business, depreciation and replacement investment matter. In that setting, EV to EBIT, or an operating profit-based metric, may provide a better view of economic performance. For an early-stage company with limited earnings, EV to sales may be useful because revenue may be more stable than current profit, but the analyst must still examine the path to profitability. For banks and financial institutions, PB and PE are often central because book equity and net income are closely tied to the business model. For a company with stable cash generation after interest, equity-based multiples such as PE or price-to-equity cash flow measures may be useful. Purpose matters too. An acquisition analysis often emphasizes enterprise value multiples because the buyer is valuing the operating business regardless of the target's existing capital structure. Equity research may emphasize share price-based multiples because investors are evaluating the common stock. The warning is simple. Do not choose a multiple just because it avoids the hard issue. EV to sales can hide weak margins. EV to EBITDA can hide heavy capital expenditure needs. Good valuation asks what the multiple reveals and what it conceals. Comparable company analysis should usually produce a valuation range, not a single point estimate. Peer multiples vary because companies differ in growth, margins, risk, capital intensity, reinvestment needs, and investor expectations. A full peer group range may be useful only when all the companies are genuinely comparable. Often, analysts focus on a more central range to reduce the influence of outliers. The median can be a helpful reference point, but it is not the answer by itself. If the target has stronger growth, higher margins, lower risk, better returns on capital, or more durable competitive advantages, it may deserve to trade above the peer median. If the target has weaker growth, lower margins, higher risk, heavier reinvestment needs, or a less durable business model, it may deserve to trade below the peer median. The selected multiple should always be supported by economic reasoning. It is not enough to say the target deserves the median. The analyst must explain why the target belongs at that point in the range. This is where value drivers become essential. Important drivers include growth, margins, reinvestment, risk, competitive advantage, and return on invested capital. Sensitivity analysis helps us see which assumptions matter most. We can test different selected multiples, different normalized metrics, different net debt adjustments, and different share counts. A good valuation does not hide uncertainty. It organizes uncertainty so decision makers can understand it. Now, let's connect multiples valuation with DCF valuation. DCF valuation and market multiples are often used together, but they answer different questions. DCF valuation connects value directly to forecasts of cash flows, reinvestment, terminal value, and risk. Comparable company analysis asks how the market prices similar companies today. Precedent transaction analysis asks what buyers have paid in actual acquisitions. Each method has strengths. Each method has limitations. When DCF and multiples produce similar valuation ranges, the analyst may gain confidence that the assumptions are reasonable. But when the methods produce very different ranges, the difference should be investigated, not averaged mechanically. A gap may appear because the DCF forecast assumes stronger growth or higher margins than the market is pricing. It may appear because the peer group is not truly comparable. It may appear because the chosen multiple ignores differences in capital intensity or risk. It may also come from terminal value assumptions, sector optimism or pessimism, inconsistent treatment of cash, debt, leases, minority interests, or non-operating assets. The target may also have company-specific opportunities or risks that the peer group does not reflect. Reconciliation is a professional judgment exercise. The goal is not to force every method to agree. The goal is to understand why they differ and whether the final valuation conclusion is economically defensible. Let's finish with common mistakes and a practical valuation mindset. The first mistake is using a broad industry label as comparability. Companies in the same sector can have very different economics. The second mistake is mixing enterprise and equity metrics. That creates inconsistent multiples and weak conclusions. Another mistake is ignoring leverage. Equity multiples can be distorted when companies have different debt levels. Analysts also make mistakes when they fail to normalize results, treat the peer median as the answer, or ignore the assumptions implied by a high or low multiple. Before applying a selected multiple, ask a disciplined set of questions. Is the value measure consistent with the financial metric? Are enterprise value adjustments handled correctly? Is the financial metric normalized for unusual or non-recurring items? Are the peers economically similar, not just similar by industry label? Is the selected multiple consistent with the target's growth, margins, reinvestment needs, and risk? A multiple is most persuasive when the analyst connects market evidence to the economic drivers of value. In managerial settings, the best output is often not a single valuation figure. It is a clear explanation of the assumptions that must be true for a price to be justified. That is the real power of market multiples. They turn market evidence into a decision framework. Thank you for joining me today. I'll see you in the next video.